Brilliant. I think we'll get started. Good morning, everybody, and welcome this morning to Life After Brexit, our webinar this morning, which is being done by Danes Accountants. And I just want to thank you all for being here. It's going to be a great webinar this morning, and we're very excited to have Danes with us. Just so you know, like I've said before, for those of you that literally just joined us, we are recording the session today. So if you do want to watch it afterwards, or you want to pass it on to anybody else, it will be on our webinar library on the Chamber's website. Like I said, we are here for Life After Brexit today, and we've got Terry Bruce here, who I'm delighted to introduce, who's going to be doing our presentation today. If you could keep your cameras, you can keep them on or off, but just make sure you keep yourself muted. That would be absolutely fantastic for today's session. And there will be a quick question and answer session at the end of the presentation as well. Terry, it's over to you.
Morning, thank you for that. The reason for the webinar today and why we're concentrating on VAT is that a lot of the emphasis on post-Brexit planning and post-Brexit business issues has been on customs duty. But in reality, VAT and customs duty are very much intertwined, and it's the VAT which is causing as many issues as the customs duty. So today, we want to specifically concentrate on the VAT issues that are arising as a result of the fact we've left the EU, and to talk about, I've got some case studies to illustrate what experiences clients have had, but also to suggest some sort of solutions and things that you can do to make life easier if you are struggling. So I'm going to cram an awful lot in because there's a lot to speak about and I could speak for hours, but I'm going to talk quickly and I'm going to cover a lot of ground, but we've got time for questions afterwards. First of all, I'm going to talk about mechanics of input VAT, import VAT, and what you can recover. I'm going to talk about Incoterms and the impact on VAT. I'm going to talk about the impact of holding stocks either in the UK or in the EU, because both have implications for businesses. I'm going to touch on the place of supply of services and the issues that people have been having with representation, which has also been a major stumbling block for a lot of businesses since the 1st of January. And then finally, I'm going to talk about the one-stop shop, which is the solution that the EU have implemented for B2C supplies, e-commerce, from the 1st of July. So a lot of material. I am going to gallop through this, but feel free to ask questions at the end. Right, to start off with, the import VAT and how that can be recovered going forward. The government has introduced postponed import VAT accounting. And what postponed import VAT accounting basically is it means that you don't actually pay the VAT over on importation. You account for it as a paper transaction on your VAT return in very much the same way as you used to do with acquisitions from Europe, except for this time, obviously, it's real VAT. So what should happen is that your freight forwarder should tick a box on the entry form into the UK for imports, and should include in box 47E a note G, which means that you're not paying the VAT and recovering it, you're actually going to put it on your VAT return. And what happens is that because that box has been ticked on your import declaration, HMRC knows that they've got to collect the VAT on your VAT return, and they will email you, or they'll put it in your gov.uk account, the amount of VAT they think you're entitled to recover, and you need to include that in boxes 1 and 4 and 7 on your VAT return. So box 1 is as if you're paying the import VAT over to HMRC. Box 4 is if you're recovering the VAT from HMRC, so it nets out to nil, and box 7 should be the net value of your purchases. Now, if your freight company has not done the importation and not completed the documentation and hasn't ticked the right box, you can still get a C79 certificate from HMRC. Now, one of the problems we're finding at the moment is that a lot of businesses do not have import VAT, and that's partly, we think, because the import declarations have not been done yet because of the simplified processes. So it may well be there's quite a lot of catching up to do, but you need to keep an eye on this and make sure that you've got import VAT evidence for recovery. If you're not doing the postponed import VAT accounting, you need to understand exactly what it is you've done. Now, you can get a duty deferment guarantee to pay your VAT and your VAT and your duty, but you can also apply for a waiver so you no longer need a guarantee from your bank. So if your duty is less than £10,000 or your liability is less than £10,000 a month, or over £10,000, there are different routes, but you can apply for a waiver for a guarantee. And that's certainly worth having, because it then obviously doesn't impact your overdraft facility or anything, so it's worth doing. The other point to point out here is that if you are importing somebody else's good to process, you have no right to import VAT recovery because they are not your goods. The only person who can recover the VAT is the owner of the goods. So if you are bringing people's goods in to process, you need to be using an IPR process that you're not charged the VAT and the import duty at the outset. So it's really important to understand that. But as I mentioned earlier on, that not everybody's doing import declarations at the moment. But one of the issues we found is that people don't necessarily know that they're not doing import declarations at the moment. So it's something that's worth looking at, because you don't have to do any import declarations till the 31st of December. But my suggestion is you start looking at it now to make sure you haven't got a really miserable Christmas. Moving on to Incoterms, and I know this is something that Rob will join me in saying this is a big issue. Now, I think pre-Brexit, people used Incoterms, and from our analysis and the training we did, it seems that a lot of people didn't really understand the impact of what the Incoterms actually meant. And to be honest, to a certain extent, for intra-community supplies, it didn't really matter. But however, they do now, because they can actually create a VAT liability, and that can become a real problem for businesses, particularly trying to sort it out after the event. So what the Incoterms do, as well as being obviously commercial practice and saying who has the costs and everything, what it does is actually dictate who is responsible for the import and who is responsible for the export. Now, this dictates where the place of supply is for VAT purposes as much as anything else. I'm not going to talk about a lot of these in detail now. I'm going to talk about DDP, because DDP is the one that gives us a bigger issue. So I'm going to go forward a bit now and talk about DDP and then come back to this slide. The problem is, if you are supplying on a DDP basis, it means that you are treated as moving your goods to yourself. And if you're supplying on a DDP basis, it means you have a liability to register for VAT in the member state where the goods are being delivered, unless you're using transit, but we'll talk about that later. So fundamentally, businesses have decided to deliver on a DDP basis so that the customer does not have the issue for doing the import declarations when the goods arrive. But if you are the importer of record, it means that you have moved your goods to that member state, you have to register for VAT, and you have to account for VAT on your onward supply. So it's really important, if you are delivering on a DDP basis, that you understand that and you understand your liability. Now, this is one of my clients here had this particular issue where I think because at the beginning of the year, there were a lot of problems with declarations and people just moved goods willy-nilly. And in this particular instance, my client was able to move goods to Slovakia, Germany and Poland on a DDP basis, but did not actually register for VAT in these countries. They only did it to try and make life easier for their clients. They subsequently moved to a DAP basis, but they still got the problem at the beginning of the year where they imported into these countries and they incurred import VAT where they were not able to recover it. Now, in Slovakia, they've been able to come up with a situation that they can actually reverse charge it onto the end customer. So it's not the end of the world because they apply simplifications, but they are required to register for VAT in Germany and Poland because there is no simplification there. So that means because of these single transactions that happened at the beginning of the year, and not high value, I think the VAT's about 10 grand in each country, they're required to get a VAT registration and to account for, submit VAT returns, and that in itself is quite expensive. There were also cash flow issues because they incurred the VAT, they weren't able to recover it initially. And now they've got the potential for penalties because they imported goods into those countries without fulfilling the local regulations. So it's a big issue. And the cost of registration and compliance is expensive because a VAT registration can cost about £1,000 and a VAT return is going to cost about £500 there or thereabouts. And also you've got representation issues, but that's a separate thing we'll talk about in a minute. So they cannot ignore the fact they had this liability from January because it will be picked up. It will be picked up either in their records or it will be picked up in their clients' records. So that is a big issue that you need to think about. So if I pop back a couple of slides, there are issues that have arisen from the Incoterms, and a DAP for me is the biggest issue. But there are other things to think about. So a lot of businesses decided at the beginning of the year they were not going to deliver on a DDP basis, they were going to deliver on a DAP basis, and they thought that their clients would be happy with that. And it turns out the clients were not happy with that, because they had to incur the cost of the paperwork, they had to get an agent to do the paperwork for them. So many clients experienced goods being returned or having to give a discount to the end user to do the paperwork for them. One of the issues arising from the DDP is that they have brought goods into multiple positions across Europe. They've gone into Calais, they've gone into Rotterdam, they've gone into Belgium, they've gone all over the place. And that necessarily means that multiple VAT registrations are required, because you have to have a VAT registration in each of those member states. There is an alternative approach. You can actually create a sort of strategic VAT registration somewhere in Europe, which is a clearance centre. So if you only move your goods through one place in Europe, say for example Rotterdam, you could have a single VAT registration in the Netherlands and then do intra-community supplies across from there. And that would avoid, you'd have to have one VAT registration, but it would avoid the other registrations. So strategically, you need to be looking at the way you do business in order to avoid these liabilities and these potential costs. What we're seeing more recently is that people are setting up EU entities, so a company in different member states, simply because that then helps them in terms of getting representation. So that's something else to consider. So I'll move on from there. Some of the other issues we've encountered with the Incoterms, and some you could have anticipated and some I simply did not think anybody would ever do, but I'll go through them here. We had one client, and we've got one client, where the freight company has unilaterally declared that all sales into the Republic of Ireland are going to be done on a DDP basis going forward. Now, it's got nothing to do with the freight company, what your contractual terms are. But what they hadn't understood, they decided to do DDP because it meant life easier for them. They could just clear into their warehouses and they could just do the declarations. But they didn't realise that what that does is create the VAT liability issue for the client, the supplier. So that was given short shrift. But the issue there is that the freight company felt that was something that they could do and it would make life easier without understanding the VAT ramifications. What we've also encountered is the freight company not declaring a business's EU VAT registration number on imports. And this has happened quite frequently, which is surprising. So even though the UK company does have a VAT registration in Europe, because it's required to deliver on a DDP basis, and a lot of businesses supplying companies like Wayfair or Amazon are required to deliver on a DDP basis. But the freight company has not used the local VAT number, it's used the UK VAT number, which is obviously completely incorrect, but it then gives you the issue to do with VAT recovery. So that is a fundamental error that's going to cost businesses money. And I've got slipped to the bottom here because we had the same sort of issue with a courier who was charging the supplier import VAT and using their UK VAT number, but the client compounded it because they're importing into Germany, they're incurring German import VAT because the courier was using their UK VAT registration number, not their German VAT registration number, and they've actually recovered the VAT on their UK VAT return, even though it's German VAT. So, as I said, things that you didn't think could happen do happen. And I think probably because people are not getting their head around what the place of supply is, Incoterms are just treated as something that is a contractual position, but it actually creates VAT liabilities. And another issue we had with a courier, so you can see a lot of this comes down to communication with the freight company, is my client supplies on a B2B basis to a French customer. So that's just an export from the UK and import into France. But they deliver to the French retailers' clients, to its customers. So the French customer French supplier is charging them VAT, but the courier, because it was delivering, was also collecting VAT from the consumer, which caused all sorts of issues and resulted, not least, in double taxation. So it's really important you understand the Incoterms, the impact of the Incoterms, and it's really, really, really important you have these conversations with your freight companies and your couriers, because that is where a lot of errors are happening. I mentioned stocks at the beginning, and a lot of this all comes down to the fundamentals of VAT, the place of supply rules. And I think we've forgotten, because we've been part of Europe for so long, the impact of the barrier between the UK or GB and Europe now. When we were part of Europe, we had a simplification for call-off stocks and consignment stocks. So if you were sending your goods into Europe and they were going to be held, say, for example, in Germany until the client called them off, then that would just be treated as a dispatch from the UK and an acquisition in the EU, in Germany. However, the place of supply of the goods is Germany. So if you are holding stocks in Germany, you will be making a supply from yourself in the UK to Germany, and you will be selling your stocks from Germany, which means you have to have a VAT registration. So you have UK export, you have German import, and you have German sale to your end customer, because you have that gap in the middle where you now have to register because your stocks are there and the place of supply of the goods is where the stocks belong. Now, there are various ways of doing this. You may be able to come back to the same thing I mentioned earlier on. You may be able to have a single warehouse in Europe somewhere, so you could bring all your goods and hold them in a warehouse, a customs warehouse in the Netherlands or Belgium, for example. And I'm deliberately choosing Netherlands or the Belgium because they tend to be typically the easiest place to have warehouses in Europe, but you can have it anywhere else. You can also consolidate your stocks in Europe in one single VAT registration. So if you are bringing all your goods into one place, or if your courier has a hub somewhere where stocks are imported into and then couriered out from, you can have a VAT registration in that one place. And that would then mean that your ongoing supplies are intra-community supplies, not UK supplies. But the main point is, if you have a stock, you have to have a VAT registration. Now, it's worked the other way around as well, in that if EU businesses have got stocks in the UK, they are also required to be registered for VAT because they no longer have access to the simplification either. And we have found that some businesses did prepare for this pre-Brexit, but others didn't. And we've just dealt with an Italian business which had got stocks in the UK, wanted to take them back to Italy, didn't know what it had to do, whether it had to have a VAT registration and sell back to itself. But in the end, what they could do is they could create a UK EORI number and export the goods back to themselves in Italy under return goods relief. But the fundamental position is, if you've got stocks, you've necessarily got a VAT liability. Now, one of the biggest issues that is coming up all the time now is the requirement for representation in Europe if you are making supplies there. And one of the problems we've got, pre-Brexit, it was always an issue because every member state, although we had the same legislation, every member state had its own different ways of doing things, its own rules and its own views on things. So, but that still happens now, only we're not part of Europe. So different member states have different obligations, and you cannot make an assumption that they're all going to require the same thing. I would say that Italy and Spain remain incredibly difficult because you are required to have VAT representation and Spanish representation, and you may have to have guarantees in place if you are importing into those countries. So you need to check whether you need a fiscal representation for VAT purposes, but in most member states you are going to need a customs agent there as well, which you're going to appoint, otherwise you cannot import. And finding a customs agent that's prepared to act on an indirect basis, so acting on their own behalf, is incredibly difficult, even though businesses put guarantees in place. So I think that's one of the things that's been stalling businesses, is not having the right representation, but not necessarily knowing what representation is needed prior to actually going and getting VAT registrations and making supplies. That's something you really need to understand fundamentally, what the local rules are. And as I said, every member state has its own specific rules. And some of you may be using Regime 42. Regime 42 is a simplification for importation that only applies in Belgium, France, and in the Netherlands, but on to a lesser extent. Now, what Regime 42 does is it enables you to import using your a sort of a global VAT representative, and you never have to have a VAT registration in that member state, because the global representative will act on your behalf, and you will then just declare an inter-community supply to the end user. Now, it's in the European law. Not every member state applies it, and there are only certain firms I know that are actually using this, but this can provide a solution, but you need to understand exactly what it is you're dealing with. But that can help if you've got a reasonably simple strategy for dealing and supply chains for dealing with Europe. It might be worth looking at to avoid a VAT registration everywhere. Place of supply services. In reality, this hasn't changed. The same rules apply because the VAT legislation is the same. So people get tangled up in this, and this isn't new, as I said. Normally, B2B supplies of services are subject to the reverse charge. That means if you're supplying a business from the UK and you're supplying services to someone in the EU, you do not charge VAT. You just, they would account for the VAT on their VAT return as a reverse charge. And this is designed, if you think of the logic, to make sure it's not cheaper to buy from another member state or another country, because it's the local VAT rate that applies. So if it's not cheaper to buy from the UK than it is to buy from a Hungarian supplier, for example, just because the VAT rate's lower, because local rate will apply. But there are some exceptions to this basic rule. So if you've got services related to land, or if you're hiring transport, or where you're doing where performed services, these are just examples, you may have a requirement to register because the place of supply is where the land is situated. And this can really catch you out. So for example, even if you're just going and installing a sign in a shop, that can be seen as being a construction service, a service related to land, and you may well have an obligation to register for VAT because you're supplying that service. Even if you subcontract it, because the subcontractor will be acting on your behalf, so it will charge you VAT, you will charge the client VAT, because the place of supply is where the land is situated. So you need to be very clear what the VAT liability of your services are and what liability you may have to register for VAT. The specified supplies order is specific to financial services. And what it used to be is if you were supplying financial services to a business outside the EU, then your supply would be treated outside the scope of VAT with full VAT recovery. Now, because the EU, we're outside the EU, the financial services specified supplies order now applies to supplies to the EU. So that is a bonus if you're working in the financial service sector, an inadvertent bonus possibly, but anyway, it means you get full VAT recovery on financial services. Now, B2C supplies are different again, and I'm going to talk about B2C supplies of goods in a second, but B2C supplies to people in Europe now will still be outside the scope of VAT in the same way as it used to be when they were supplying people outside Europe. So services related to land, as I said, the definition is quite wide. You need to check the local definition. So if you're doing something in, well, I'll talk about Ireland in a minute, but Ireland has got its own specific rules, and they actually reverse charge it anyway. But if you are providing construction service in the Republic of Ireland, then your service will be reverse charged. But you need to speak to your customer to understand exactly how they're doing it, and you may need an Irish advisor there as well. So the place of supply is Ireland. Your services are liable to VAT in Ireland, but they're also subject to reverse charge because of the local rules. And a lot of member states do apply the reverse charge to construction services, including the UK, as used to be. But you need to be absolutely clear, and you need to be absolutely clear what services you're delivering and whether they fall under the rules or not. So I'll give you some example here. Construction, maintenance, estate agent, surveying relates to a specific piece of land. The place of supply is always where the land is situated. The things that are typically excluded from this are things which are sort of more generic. So advice about property markets or feasibility studies about a particular building in a particular area and the environment and the economy in that particular place. Because they're generic in nature, they don't relate to land, so they're not, but you need to check the local position. And you may find that you might have to have a VAT registration requirement, but your services can be reverse charged. As I said, the local rules do vary. Now, B2C supplies of goods. And I've got a confession to make here, because with all my clients pre-Brexit, I was saying, who are supplying on an e-commerce basis, don't worry about this, because come the 1st of July, the EU is introducing a one-stop shop, and it's going to be dead easy, and we're all going to be very happy, and life will just go on as normal. So I underestimated the impact of the one-stop shop, and I'll go into a bit more detail later on, but I just wanted to confess to that now. So if you're supplying B2C goods across Europe, pre-Brexit, we had very specific rules. We had the distance selling rules because we're a party to the same rules as Europe. That meant that you only charge VAT until the distance selling threshold was breached in each member state. Now, a member state can have a threshold of 35,000 or 100,000. For example, Germany had 100,000. So if you were supplying goods to consumers from the UK to Germany pre-Brexit, you could have sold up to 100,000 euros worth of goods without having a VAT registration requirement in Germany. You just charge local VAT. Post-Brexit, we lost access to the simplifications from day one. Now, what that means is, from day one, the VAT and the tax, if there was any duty, is due where the consumer belongs. Now, that can mean that you have to have multiple VAT registrations across Europe if you're supplying into, say, for example, all 27 member states. The basic position is the place of supply of goods is there, and VAT has to be accounted for there. What is possible, and what businesses do is that the courier can collect the VAT and duty if it is due from the consumer. But this causes issues because the consumer may not be expecting to pay any VAT and duty on importation and may refuse to pay, in which case they come back. And I've got some clients who have actually, the cost of returns has been quite astonishing since the beginning of the year, and particularly with clothing retailers, because people just are not going to pay. They bought something quite cheap, they didn't realise they're going to have to pay the extra VAT on it, and they don't want it at that price. So that can create barriers to trade. So the EU one-stop shop, which I pinned all my hopes on, and it still may work, but it will work, but it's going to be very complicated, and you need to understand how it affects your business. So the one-stop shop is effective from the 1st of July this year. And if you are selling to Europe, you need to get your VAT registrations in now. This abolishes the distance selling rules. So from the 1st of July, the distance selling rules just disappear completely. It removes the low value consignment of 22 euros. And if you were supplying below 22 euros before, you didn't have to account for VAT or duty on those goods. But the EU believes that costs about £7 billion a year in lost revenue, so you can understand why they're putting an end to that. They also believe it's distorting competition. And this is largely, and I think we've all probably experienced this, where you buy something for, say, 70 quid and the label on it when it gets imported said it's worth 22 euros. There's no VAT and duty due. So you can understand the ability there to avoid tax. But what they are doing is introducing a de minimis limit of £10,000 across Europe. So if you sell goods or services to consumers into Europe and your total value of sales is less than £10,000, then you can ignore it and just carry on as you were before. Obviously, 10,000 euros is not an awful lot. But what the one-stop shop fundamentally means is that instead of having to have a VAT registration in every member state in which you make B2C supplies, you can have a single registration to put like a clearing form for all sales to Europe through this single portal. So in essence, it's very, very, very simple, that all you do is you declare all your sales to Europe through a single, it's a form, it's not a registration, it's a form, but we can talk about that in a few more minutes. You need to determine where your member state of identification is going to be, and to a certain extent you have a choice. If you've got an establishment in a member state, then your member state of identification will be there. If you've got warehouses and so on, you might want to have a member state of identification there. If you're using the import one-stop shop, which I'll talk about in a minute, you need to have a member state of identification, which will be where your intermediary belongs. So you would have one registration for the one-stop shop somewhere in Europe, and all your sales will be declared through a single portal. And I'm going to go into details in a minute. This has arisen through the mini one-stop shop, which if you're supplying electronic services into Europe at the moment, you would know, because it just means that it works exactly the same way. If you're supplying electronic services to individuals, you would have registered through a mini one-stop shop and done exactly the same thing. So in principle, it's dead easy, but the details are really, really, really tricky to negotiate. And I've simplified this, so I am going to go through this quickly, but if you are doing this, I think it's something it's worth picking up and looking at in details, because it can really impact the way you do business. So there are 3 options under this one-stop shop. So it's not even a one-stop shop, it's 3 one-stop shops. There is the Union one-stop shop, Union OS, but this is only for intra-EU B2C goods and services, so it will not impact you unless you are actually an EU registered, an EU established business. So we'd ignore that. We've got the non-Union OS, which is for B2C, oh sorry, the way around. Union OS is what you will use, non-Union OS is what you won't use. B2C services by non-EU business. So that is what the old MOS was, and it will become the non-Union OS. So Union OS is what you use for your B2C services if you are established if you're not established in the EU. And there's the import OS, which is for imports of goods below 150 euros. So as I said, the premise is that VAT is due in the member state of consumption. You need to file your one-stop shop return in the member state of identification. You will have one-stop shop return. You might have an IOS return as well, but you'd have one-stop shop return for all supplies in Europe. As I said here, they're going through establishments here for non-EU companies. So if you're a UK business, your member state of identification is, for the non-Union OS, the member state of choice, Union OS, where goods are dispatched from, and the IOS is where your intermediary is registered. So this is what a one-stop shop return will look like. So you can see here that if you're supplying goods into France to consumers, there's 2 different rates, 20% and 5%. What you do is you declare the net value of your sales and the VAT due on this. And you ultimately then only make a single payment to the portal of 141,000 euros, and that then gets divvied up across Europe. So all the VAT is collected in one place and divvied up across Europe. The returns are they're generated automatically. For the import one-stop shop, and we'll talk about that in a second, the returns have to be done monthly, but for non-Union OS and non-Union OS, then you have to do them quarterly. There are separate rules for marketplaces. Bear with me a second on this one. I want to just check something. Right, I'm going to go back a second. I normally do a great long session on the Union OS and the non-Union OS, and I've cut it down. I think I've probably cut it down a bit too much. Let's go back to this then. So what the Union OS is if this is, you have to get the goods into Europe in order for the Union OS to work. So if you look at the import one-stop shop first, nearly swore then, forgot we've been recorded. The import one-stop shop is very specific. It's for goods that are imported from the UK, or for anywhere, but for the UK into Europe, and the value is below 150 euros. Now, the 150 euros is really important because below 150 euros, there is no duty. So we're just talking about VAT. So if what you're doing is you're only supplying goods to consumers in Europe, and all your goods are valued at less than 150 euros, you can register through the import one-stop shop and account for VAT on all your sales through a single registration. But you are required to appoint an intermediary somewhere in Europe to do the import declaration for you. And you can choose wherever that is because you've got no establishment in Europe. The Union OS is different because it's for any goods. And for import one-stop shop, you cannot use, it cannot be used for excise goods. The Union OS is for goods, it can be for services, but we'll look at goods, for goods that have to, are over 150 euros or already in Europe, because they only apply to duty cleared goods. So if you are supplying goods to consumers from the UK into Europe, you have to clear your goods into Europe, so pay any import duty, any import VAT, before you can use the one-stop shop. And that is because the one-stop shop does not deal with duty, it only deals with VAT. So if this is what you're going to do, you'd have to have a VAT registration wherever you are clearing the stocks, and then you would then account for VAT through the one-stop shop for all of your sales. But this becomes very complicated because you need a VAT registration to start off with, and then you need to identify how you're going to account for your sales, because some businesses may do some sales under 150 euros, some sales over 150 euros. They may bring most of their stocks into Belgium, but do ad hoc supplies to other countries. They might want a mixture of one-stop shop and import one-stop shop, but it does become very, very complicated. The principles are dead simple. It's the actual details behind it. So apologies, I should have gone into a bit more detail at that point. There's a further complication, as if you needed one, because marketplaces may well be liable for the VAT rather than the supplier. And this works in very specific circumstances. So platforms will become liable to pay the VAT, to be registered for the one-stop shop or the import one-stop shop, if goods are sold on a platform to consumers in the EU, if the platform is treated as the principal in the transaction, so the buyer and the seller, if the goods are imported into the EU and the value of the goods is less than 150, the platform will have to use the import one-stop shop. Otherwise, I'll have to use the one-stop shop. And as an example here, this is taken from the Europa guidance on this, and I think it's quite helpful because it goes through in stage by stage. So if the electronic interface, so the marketplace, facilitates the distant sales of goods, and the goods are dispatched from a third territory or a country to the EU, then if the goods are under 150 euros, then the electronic interface is seen as the deemed supplier, and it has to account for the one-stop shop. If the goods that are sold by a supplier who's not established in the EU, then the electronic interface is also the deemed supplier. So in addition to understanding whether you need a one-stop shop registration, an import one-stop shop registration, you need to be speaking to your platform to see whether they are then going to become liable for accounting for the VAT rather than you. And the way that this works is that although you may be making a sale to the EU consumer, they create a fictitious supply to the electronic interface. So the electronic interface is seen as being both the buyer and the seller to the EU customer. So you need to be looking at the paperwork, you need to be looking at transactions, you need to be looking at how you're accounting for this VAT and what your liabilities are. So in this scenario, if the goods are outside the EU, then the one-stop shop is what you are looking at. The deemed supplier by supplier would be outside the scope of VAT. So if the goods are outside the EU, you're selling on a platform, then the supplier is treated as making a zero-rated supply to the platform. There is no duty because it's over under 150 euros. So the platform, the marketplace, will account for the reverse charge and the acquisition of its goods. So you're seen as being the supplier of the goods to the platform, which might take some getting around. If, however, the goods are inside the EU, so you've imported them into the EU, then it's the one-stop shop that will apply. You will be seen as making a zero-rated supply to the platform, so this is the deemed supply, but the platform will account for the reverse charge in the acquisition. So if you've moved your stocks into the Netherlands, you're selling on a platform, you will have to do a zero-rated supply to the platform, not to the end consumer, and it will be the platform that accounts for the end consumer. Now, a customs warehouse normally holds goods in suspension and the goods don't actually hit the territory, but so they're treated as not being cleared. But for the purposes of the one-stop shop, they are treated as being within the territory, and you do have to have a VAT registration, and you do need to make the zero-rated supply to the marketplace. Now I've gone through this very, very quickly. There's an awful lot of detail here, But the thing to know is that there are penalties for getting it wrong. There are penalties for failing to notify a requirement to register. There's a failure to submit returns, and there's also a 2-year quarantine. So if you make a mistake from the beginning and you're late registering, you could potentially find that they will not allow you to use the one-stop shop or the import one-stop shop for a 2-year period. Now that will mean that you will have to have VAT registrations wherever you're making supplies, or you can continue to use your courier to collect the VAT. But it's really important that you understand the implications for your business of the one-stop shop. And it would have helped if I'd explained it a bit better, so I apologise there. But in summary, if you're a UK supplier and you don't have an establishment in the EU, then these rules are going to apply to you. For any supplies under €150 via a platform, the platform will be the deemed supplier. So that's when you do your supply to the platform accounts for VAT. For all supplies under €150 where you're supplying directly to your consumer, then you will need to register for the import one-stop shop, and you will need to appoint an intermediary to do your returns for you. Now, your intermediary can be based anywhere, and you might want to choose one, for example, in Ireland because of the language issues. It's probably a bit easier, although, to be honest, most intermediaries, the English is very good. If you've got supplies over 150, you will have to declare the import somewhere, and that will mean that you will need a VAT registration somewhere. You will also be required to have a one-stop shop registration, and you may have to appoint an intermediary to do that for you. For supplies over 150 via a platform, you will have to declare the import VAT, but the platform will be the deemed supplier, and you will then make a zero-rated supply to them. So fundamentally, this comes back down to the place of supply for VAT purposes, which takes us back to the very, very beginning. But you need to unpick your supply chains. And what we've found is that some of our clients have gone ahead and they've got VAT registrations everywhere because that is the supply chain that they've always had, and that's what's always worked for them. But I would recommend that you stand back and you'd look at your strategy and you'd go, well, hang on a second, we've always done this. But to have VAT registrations everywhere is going to be very, very expensive, and it's not going to work for us. What do we do? Do we bring our goods into one place? Do we use the courier to collect the VAT? What changes do we need to make to our website? There are all sorts of considerations there to make. But you need to be looking at it now and thinking, do I need VAT registrations? Have I got stocks? Have I got warehouses? Do I need an establishment? Do I want an establishment? Do I want a separate legal entity? Do you need a one-stop shop registration? Do you need an import one-stop shop registration? We've got clients that have got VAT registrations because they supply on a B2B basis to Amazon on a DDP basis. So they need those VAT registrations for that purpose. They will be using those VAT registrations to account for their one-stop shop supplies. So supplies over €150 or supplies for goods that have already been cleared into Europe. But occasionally, they get clients who want them to supply goods to them on an ad hoc basis across Europe, B2C basis. So they're going to be using the import one-stop shop for those supplies. Of course, the alternative is then to look at it and say, well, actually, we only do 250 quid's worth of supplies to Hungary a year. Let's just turn that off on our website because it's not worth the hassle of actually dealing with it. But that then just becomes part of your strategic decision about your supply chains. You need to be talking to your platforms if you're selling on platforms now to understand what they are going to require of you. And my experience so far has been that businesses like Amazon and like Wayfair and so on are not necessarily sensitive to the requirements for their suppliers. So it's something that you need to be thinking about, and whether their decisions have an impact on you and make you require you to behave in a different way and have a different set of supply chains. One of the issues with the import one-stop shop, or even with the one-stop shop registration, is VAT recovery, because unless you've got a VAT registration, you can't recover VAT on any costs incurred. So you need to be thinking about that. This is particularly where the one-stop shop can also be used for services. So where you're selling tickets, for example, say you hold a pop concert in Bulgaria or somewhere like that, and you're supplying to consumers, you can, instead of having a VAT registration there and accounting for local VAT through your VAT registration, you can now use that, or you will be able to use that, the one-stop shop, to account for the VAT on your sales. However, that does not give you the right to input tax recovery. And if you are running a local event, you might think, brilliant, one-stop shop solves us our problems. We don't have to worry about charging VAT and registering, but you've got to then build into the VAT, you've got local costs that you might not be able to recover the VAT on. So it's worth considering. You'd have to do that through a 13th directive claim, and not all member states have got a reciprocal arrangement. For example, Spain doesn't have a reciprocal arrangement with us, so you won't get your VAT back through a 13th directive claim. So, as I said, you've really got to think about your European strategy. You've got to stand back now and think, okay, what's going to work for us? And try and set it out now and do some brainstorming now about how it works. So from a summary position, as I said, it's a simple concept. It really is a simple concept. You just account for VAT on your sales to consumers through one single portal. However, it's the details which are highly complex, and you need to stand back and map out your optimum strategy, which may not be the strategy you've got at the moment. Again, I've got another client where they're considering just bringing all their stocks into the Netherlands, having a single VAT registration in the Netherlands and doing everything from there, rather than their current model, which is VAT registrations everywhere. But it comes down to choice, and it comes down to knowing what your position is and being able to work out the financial impact. I think one of the experiences I've had of clients dealing with Brexit is that they've gone ahead and they've pushed and pushed to make things work, and haven't really considered the financial impact of that. They just wanted to make sure they could make sales, and they haven't really evaluated how much that's cost them. So it's really well worth standing back and looking at the actual financial implications of what you're doing going forward. Now, I apologise, I know I rushed that very, very quickly. Any questions at all?
We had one question, Terry, from someone about, I'll just see if I can find it in the chat, about the one-stop shop. Is that a 10,000? Is that a 10,000 limit for the whole of Europe or per member state?
It's for whole of Europe, goods and services.
Okay. Yeah, I think that is the only one I can see.
Brilliant. So I know there's still 27 of you on. So obviously we finished the presentation. So has anybody got any questions for either Terry or Darren today in reference to the presentation you've just seen? We're more than happy to take them by the chat if you don't feel comfortable sort of saying them out loud. But if you do have a question, feel free to sort of bring that forward now for me.
Can I ask a quick question relating to the registration process and timings? You mentioned that there are penalties for non-registration. Are we basically saying that we have to register for the one-stop shop as of the 1st of July, or face a potential penalty if we suddenly make sales above the 10,000 threshold?
I think in theory, the answer is yes. I think in practice, there will be this sort of period of grace. But countries are taking pre-registration applications now. So if it's something you think you need to be doing, then you can start to create a registration now. I think where the penalties will come in, because don't forget, although the UK, we have specific issues because we've not been part of the distance selling rules, this is going to impact every business in Europe, because every business selling on a B2C basis is going to have use one-stop shop or import one-stop shop. So I think in reality, the application of penalties will not come on day one, but you need to be looking at your strategy and making sure you get that right, because if you make a mistake, then there will be penalties going forward.
Yeah, I mean, fundamentally, that just puts a massive block on any organisation that's expanding and growing, actually getting into Europe, doesn't it? So, you know, you reach the point where, well, we're getting close to doing 10,000 in Europe. Let's just not bother. Let's just turn it off.
Or, yeah, well, I suppose, and that's it. It comes down to that sort of cost thing. Or the alternative is to set it up and future-proof it. So what you would probably do is look at where your sales are and think, well, you can see this is optional. You can always continue to use a courier if that's what you're doing at the moment. Or you could have a strategic VAT registration somewhere in Europe and set yourself up around that. It's one of these things where what you do today is not necessarily what you want to do down the line, but it's worth thinking about now and seeing, where your periods of growth
it's just, previously the rules where you have the 35,000 per state meant you could actually start to make some money in Europe before they started to absolutely slaughter you. Now they're going to absolutely slaughter you when you've barely made an impact.
Yeah.
Because to make 10,000 euros of sales in the whole of Europe, you're going to have to spend 50,000 on marketing just to get yourself established. So people are just not going to bother, are they?
Yeah. Well, they've made it unnecessarily complicated. It's easy as a concept, isn't it? It's really easy as a concept. Have one registration account for your VAT. There you go, dead easy. Yeah. They haven't made it that way. You've got lots and lots of different options.
Yeah.
Yeah, it can be expensive, but that at least you've worked that out. Whereas I said, I've got clients who have got registrations everywhere, and the cost of compliance is phenomenal.
Oh, it's madness. Yeah, I mean, by comparison, in selling out to the States, yes, we have to have registration in every state where we've achieved Nexus, and that is potentially a bit of a pain. But you don't achieve Nexus on day one, so you can at least start to expand across the states. But Europe have shot themselves in the foot with that, I think.
Yeah, it's one of those weird ones. I think they probably had too many people sitting in a room, kind of with too many different ideas. It's very Heath Robinson. It could have been much easier.
Thanks for your answer, though. Very helpful. Thank you.
Okay.
Can I just ask, would you say that you're better off having an EU entity with OS than you would do by being outside the EU and registering? I
think that's a difficult one to answer because you do not have to have a legal entity. You can just have a VAT registration to make it work. If you wanted to set up a legal entity, and there may be reasons why you'd want to do so you don't have to have a fiscal rep, you've actually got the establishment there. And if you create an establishment, it makes life easy for VAT purposes to a certain extent. However, you've got to consider all the ramifications. You've got to consider corporation tax. You've got to consider employment rules. You've got to consider director rules, bank account rules. There's all sorts of costs involved in setting up an entity, which you really need to go through and understand exactly what it means to you. But having said that, I said you do not need an establishment for a VAT registration. A VAT registration works on its own. But I have seen more recently a lot of UK businesses setting up establishments overseas. It's one of those ones you really need to think about it and think about the ramifications for your business and what you want to be. I think it's got to be the tail wagging the dog and not the other way. You know what I mean? The dog wagging the tail and not the tail wagging the dog, but it's something to consider. But
if, for instance, you set up in Ireland, never had any stock in Ireland, that your GB company was moving the stock across to say Netherlands, that would work in terms of you wouldn't create extra. No, you talk about one of the problems with Ireland is that it's an easy place to have a VAT registration, but what it doesn't do is give you the foothold in Europe. So if your UK business is importing goods into Europe, for the import one-stop shop, Ireland would work because you're the intermediary in Ireland. But if you are importing goods into the Republic of Ireland, into mainland Europe, you cannot use the Irish VAT registration number to do the import. You would still need a VAT registration in that member state because the basic places of supply rules is that you have to do the importation at the first point of entry into Europe, which means you need a VAT registration. If you're using transit, so for example, if you are moving goods from the UK to, I don't know, think of a country. I can't think of any countries at all, gone out my head. Italy, for example, you wouldn't necessarily have to have a VAT registration in France if you used in transit because the clearance wouldn't happen to Italy. Italy's a really bad example because nobody wants a VAT registration in Italy, but you see what I mean? You've got to look at your supply chain and look where your liabilities are. But if you're moving stocks into Europe and they're over 150, then you need to have a VAT registration, but you need to have a VAT registration where those goods are entering Europe, France, Belgium, Italy, wherever they're going to be. Right, but what you could do is use regime 42 to move your stock into Europe out of the UK, give it to your Irish company, who could then start selling B2C.
I don't know. Do you know what? I don't know whether that would work. Regime 42 certainly works on a B2B basis. I'd have to think it through, to be honest with you.
Because that seems a good way to get stuff into Amazon.
Possibly. I'll tell you what, let me have a think about that.
Okay.
Regime 42 is actually very, very clever, but it's quite limited in what it can achieve. And there are very few freight companies actually using Regime 42. Now, I think that speaks volumes, because if it were easy, they'd all be doing it, because they'd all be making big money. Now, I'm not sure how it fits in with the one-stop shop. If you leave your details with Laura, then let me have a think and I'll come back to you on that.
Okay, and we've certainly found, we've done a couple of shipments using Regime 42 and that's all gone very, very well. But we haven't sent anything to Amazon yet using that.
I've got a client that is supplying Amazon on that basis now, but it's taken until now to get that sorted. I think with Regime 42, it's Europa Flow who are doing the
That's one, yeah.
Yeah, exactly. There are a few businesses in Belgium and Netherlands doing it as well, but Europa is the real one. And they had real problems the first month of operation, first month post-Brexit, but it seems to be working smoothly now. But what's supposed to happen under Regime 42 is that they're supposed to have control of the whole of the supply, the goods, the whole until the end customer. Now, I'm not sure how that operates when you're splitting things up and you're doing your consumer thing. So that's what I need to be thinking about.
Great.
Interesting question, though.
Okay, thanks a lot.
Thank you, Alistair. I'm just very conscious we've got some things coming through in the chat, so I'm trying to get through them very quickly because I'm very conscious of time. So I've just got Pete Chapman just says, please confirm the 10k limit is just for the EU businesses, so not if the UK company ships directly to the UK?
Sorry, the UK company ships directly to the UK?
Yeah, sorry. Pete, are you there? Probably not there, he's probably gone.
No, I'm here, sorry.
I noticed you've just popped in the chat, just a quick question. I just thought I'd jump you in there, if that's all right.
Thank you. Hi, Terry. Yeah,
Hi.
just to confirm, this 10k limit, that's only for EU established businesses, is my understanding. So if you're shipping directly from the UK, that £10,000 limit is not available, is it?
It should be available under the ones, if you're talking B2C supplies.
B2C, if you're just shipping directly from the UK to EU consumers, you're not holding any stock in Europe.
I understand the 10,000 applies to both. It would just apply to UK businesses and non-EU businesses, but again, I can confirm.
Okay, well, I mean, I'm sure you're right. I just felt it was just for EU established businesses, but
I think if you think about the fundamental principles of what they're trying to achieve, they do not want to have a lot of little tiny VAT registrations all across Europe. So they really don't want someone who's doing £2,000 here, £2,000 there. So I think the de minimis is just to make life a bit easy. So they take the smaller businesses off. That's the intention. So I think it works, it applies. But again, I'll let Laura know and then she can circulate that afterwards, be absolutely clear.
all right, thank you.
Just for all the questions that have been answered, what I will do is I'll just make sure that the clarification of all the answers will be sent to all of the attendees as well that have attended today. So just to bear that in mind, just in case there is some that we just need to check or just need to go back and just check the information. So I've got another one here for you, Terry. What happens at the end of the postponed VAT arrangement? We import from Germany and currently do full declarations. Will we need a deferment account after the postponed VAT arrangement?
So the arrangement, the simplified arrangement finishes on the 1st of January. It's been extended now to the 1st of January. Postponed import VAT will always be in place. So you're just talking about duty. And if there is no duty if the goods are originating from the EU, then you will not need a duty deferment account. However, if you can have a duty deferment account and you do not have to have a bank guarantee, then you can set your own account up, and that saves you from having to pay the freight company, because the freight companies collect the VAT up front, hold on to it and pay it over to HMRC 6 weeks later. So that's why they want you to pay the VAT that way. I would suggest it's usually quite a good thing to have a duty deferment account anyway. It just makes life easier because then they just use your deferment number. But it shouldn't really have an impact after the 1st of January because VAT and duty should still be applicable in exactly the same way, but postponed import VAT accounting will just carry on.
Well, fantastic. I think we've got one more question in the chat. So this is from John. We've had a notification of payment of £3,000, 2.8 in VAT and 0.5 in duty to go out of our duty deferment account next month for an import from Europe received this month. However, we've not received any invoice from UPS. So how can we claim this back through our usual VAT return? We've tried to contact UPS and not got anywhere so far.
As I said, the freight companies are one of the issues of Brexit. So they've used your duty deferment account. What you need to do, the only evidence for import VAT recovery is your C79 certificate from HMRC. So the invoice that comes from your freight company is a disbursement. It's not evidence for import VAT recovery. So if they've been using your VAT number to bring the goods into the UK, then HMRC will issue you with a C79 certificate. If you haven't got a C79 certificate, you need to ring up their helpline and ask for a duplicate C79 certificate. But the invoice from your freight company is not evidence for import VAT recovery. That is just telling you how much import VAT they've paid on your behalf. So that's never, ever, ever evidence for import tax recovery. But I go back to my point, why is your freight company not using postponed import VAT accounting? Because why would you pay VAT over to HMRC 3 months before you need to and create a take a cash flow liability? It's much more sensible to use postponed import VAT accounting, and then there is no VAT payment anyway, and HMRC just give you the information to put on your VAT return. So my recommendation there, was it DHL or UPS? I can't remember who you said, but whoever it is, you need to go back to your freight company and just say to them, we are using postponed import VAT accounting. So make sure they just tick a box when they do the importation.
Well, fantastic. So I think I've answered all of the questions in the chat. I hope I haven't missed any.
Well, you can always, if there are any further questions, I'm more than happy to pick them up, and I'll come back to you on these anyway.
Absolutely. For those of you that haven't had a chance to answer a question or have a question later on that they think about, I know Darren's put his details in the chat box there, but we will circle that out as well after the webinar itself. So we will be circling that as well, and I'll make sure Terry obviously gets the all of the details of the people that wanted answers to questions that we weren't able to answer in today's session as well, just to clarify those. Fantastic. It's been a great session, lots to take in. I'm not going to lie, Terry, from somebody that's not in this sort of subject. And Rob wants to say something. Hi, Rob.
Hi Laura, and hi Terry and Darren. Just a massive thanks really from the Chambers of Commerce for doing this for us. It's highlighted what an incredibly complicated thing it is. Terry and I had a chat sort of like about last October, November. Terry was taking one on the VAT issues, and we were doing the customs declarations, and we were kind of pooling our sorrows, thinking what a nightmare it was going to be, and it hasn't been far from it. We are doing customs declarations down at the Chambers of Commerce. If you didn't know that. We're currently the second busiest chamber across the entire chamber network. So we do more declarations in the massive chambers like the North East, Birmingham, Manchester. So we're getting there. But you know, just again, a massive thanks to Terry and Darren for arranging this, and Laura for hosting it. It's I'll be honest with you, it's absolutely blown my mind. I thought I kind of had a bit of a handle on VAT before the 1st of January, but I'm just blown away. So thanks ever so much. We really appreciate it, guys.
Yeah, just to recur with Rob there, absolutely blown my mind this morning, Darren and Terry, I have to say, completely, and I'm probably going to need to watch it about 3 or 4 times before it actually sinks in. But I just want to say a massive thank you for all of you that have joined us today. A massive thank you as well. If you have missed it, or if you missed the first part of it, you can watch it on a webinar library, and we will be sending you, of course, all of the details at the end of the webinar. Just want to thank you all for being here today, and have a wonderful Tuesday. Thank you. Thanks a lot. Bye, everyone.